Ladies and gentlemen, welcome to this USA housing market video today. My name's Neil McCoy-Ward. I've been involved in the housing space since 2005, so this is over 16 years now. I'm a broker, I have a property management company and a training academy. So that's my background in the housing market property industry. So if you are not in the USA, let's say you're in the UK and you're wondering when is this UK update coming out, Neil? I'm going to be bringing that to you tomorrow. So just stay tuned to the channel and you will see a UK housing market video tomorrow. Now there's a huge amount that I could talk about in today's video since it has been some months since my last update on the USA housing market. And this is simply because the housing market is so volatile right now. It's quite out of control, but we're going to cover all of those metrics. But what I want you to understand first and foremost, and if you understand this, you'll understand 99% of what I talk about. This housing market is not a rational market based on statistics and sound investment and things like that. This market is a fear-based market. It's both a fear and greed-based market. So you have the fear from the normal everyday families, the couples, maybe you're an individual, and many people are just afraid of these high prices getting out of control and being priced out of the market. Then you have the greed-based, which is mainly the institutional investors. I'm going to talk about that on this video. It's pretty scary stuff, the way this is moving, who are just going out there and buying up everything they can with money that they're getting at next to 0% interest. So I'll cover all of this in this video. But the main thing to bear in mind is that this is a psychological and not a rational housing market. And if you look back through history, all psychological markets have always ended very badly. So let's look at some statistics before we get started then. So the typical US home value climbed to $281,370 in April 2021. So that's up 11.6% in the last 12 months. I wouldn't be surprised at all if we are edging nearer to 13-14% as we get into June. I wouldn't be surprised at all. And that was also in April a new record high 1.3% rise month on month. So this tells you what sort of housing market we're in right now. The next point is very, very crucial, is that roughly $36,000, and this is the crazy thing, I was only $3,000 off my forecast of what would be added. So $36,000 is now being added to the price of a new home due to the price of lumber alone, having risen 300% in the last year. Also, drywall, copper, steel, but pretty much all materials right now are up massively. But of course, there's no inflation, Neil. No, there's no inflation at all. If you remember a year ago, I forecast this high inflation, and this is on the back of the quantitative easing, the stimulus. I said all of this inflation would come through, especially with the supply chain issues that have been hitting, and of course we don't even need to go into the Suez Canal situation that occurred. We have these huge supply chain issues, and especially as different countries are doing lockdowns and everything that goes with it, we're probably going to continue to see these supply chain issues until both two things happen. Entrepreneurs jump in and say, wow, look at what's going on. I'm going to create a new startup company doing the same service, which will help to bring the prices down. This is a deflationary measure. Or the government starts to ease these lockdowns, and that will also help to get people back into the workplace and to ease the supply issues. But isn't it interesting how last year I was called a conspiracy theorist for making these inflation calls that I said would come in. I talked about these huge calls in inflation that were going to come through. And everyone said, no, this is I'm being a conspiracy theorist. And now look at where we are. And I don't think this is over yet. I think we're going to continue to see a lot more inflation coming through, not just hitting the housing market, which of course will push up the price of new builds, but it's going to affect you in all aspects of your life. So let's start with the two biggest fundamentals then that I always say affect housing prices. Number one is interest rates, or more specifically, the mortgage interest rates. These are still historically low at the moment. Yes, they've picked up a tiny bit in the last month, But I actually foresee interest rates, specifically not base rate, but the mortgage interest rates, edging up the further we go into 2021. And I definitely think they'll be higher in 2022 than they are right now. What does this do? It increases or decreases the affordability of homeowners looking to purchase a house. It really doesn't have much effect on the big hedge funds and pension funds, which I'll go on to. Crazy stuff happening there. But it will affect the average homeowner. And this is another problem that you have right now, is that you're not competing with Mrs. Jones, Mr. Smith down the street right now for a house. You're competing with hedge funds, pension funds, who have been hammered with their investments last year. And now they're looking for ways to recoup that with more stable income. So what are they doing? They are competing with you for houses. A lot of people don't know this. You see them at the open houses and you think this person is just a normal person like me, but they're usually not. Oftentimes they are acting on behalf of these big funds. I really don't think this is right. I think it's quite immoral that this is being allowed to go on, but alas, this is the world that we live in right now. And of course, the second thing I always talk about is inventory levels. We are still hugely down on inventory for where we need to be to make this a stable and sustainable housing market. However, I do think this is going to pick up. I think inventory levels will pick up, especially when we get later on this year. I think they're going to pick up a lot more. And I'll talk about that later on, why there's a few variables to that. But as we go forward, I do believe now we're going to see more inventory hitting the market, as long as the home builders can get the materials they need at the right prices coming through these supply chains, which of course we're having a lot of issues with. So what do rising interest rates and rising inventory mean? In theory, and of course this is in theory, it means that house prices should come down. But I want to take us over to the shared screen now. I want to show you a load of data and graphs and all the usual stuff that you've given me the feedback you love the most. Let's go over to the shared screen now then. Okay, so we're going to start with the home price index, and this is the Case-Shiller home price index. This is from the genius who is Robert Shiller of Yale University. And actually, before I even tell you about this, I'll tell you something that surprised me last week. It's not very often that Robert Shiller is taken by surprise, because this guy is just an absolute genius. But he said in an interview just last week, when the interviewer asked him, were you surprised at the home prices over the last year and also month on month? And he said, yes, I was extremely surprised by what's happened. I didn't expect these sort of numbers. If you look at most forecasts, including the Federal Reserve, the Bank of England, a lot of the big organizations, they were expecting house prices to go down as much as 16% during the crisis. But that hasn't happened. So here's the historic prices then of the National Home Price Index. And of course, we know what happened in 2006 to 2007. We went into this home price crash, this housing market crash, before it started to pick up then in 2012. And of course, look at where we are right now. This is just insane, actually, where we are right now. Look at this growth. I mean, this is just a huge upward trajectory now. This is what we're looking at with the housing market. Now, the last time I made this video for you, we weren't anywhere near this. We were sort of down here sort of area. So you can see this climb is just getting sharper and sharper, the incline going up. But I do think this is going to slow down as we go into the end of the year. I think we're going to see a slowdown in this very steep curve upwards. But let me show you the next thing that I think is very important right now. This is the home price to income ratio, also known as the PE ratio, the price per earnings ratio in the housing market. And I just want to show you how relevant this is. So this was the last housing bubble here, where we hit a ratio of about 7-to-1. So that means it took 7 years for your household income to purchase your home. And that was a bubble. Now, of course, it came down and reached a manageable level at about 4.8. So this was a manageable level. Before that, we're about 4.2. I think that was manageable. But 4.8 was manageable. Now, look where we are today. Look where we are today right here. We are now at 6.4. So we're not too far off now this peak that hit 7 in terms of the housing market going into this bubble territory again. And that's really crucial, and I'll come back to that. But I want to show you now the assets held outright. Now, this is the shocking thing. If you haven't ever seen me talk about this before, you may not believe this at first until you do your own research, but this is the FRED data. So this is data from the Federal Reserve itself. This isn't a third party. This isn't me making it up. These are assets that are held outright by the Federal Reserve. So they're called securities. And let me just show you this. Last time I did this video, they were about here. I think it was about 4.3 trillion. So that means trillion, because this is in millions. So 4,300 million is 4.3 trillion. Now I'll show you why this is so shocking in a moment then. Because look where it's gone. 4.3, we're now at over 5, almost 5.1 trillion. Now you might say, well, what are these assets that you're talking about here? What are these things? These are, a lot of it, mortgage-backed securities. What does that mean, Neil? It means that the Federal Reserve is buying your mortgage, or doing a swap to be more specific, with the bank that you took your mortgage through. So you think you went to, whichever bank it was to get your mortgage, and your bank holds your mortgage. Possibly not. What has happened in a lot of cases is the bank has swapped these credit lines with the Federal Reserve so they could then loan out more money, more mortgages. And you can see here that it's 2.7, almost 2.8 trillion out of all of their assets. So here we go. The total here is 5.1 trillion. And of that, the mortgage-backed securities are 2.7 trillion. So let me just bring that up. So 2.7 trillion here. So that is of a market cap. So the whole mortgage market is worth 10.3 trillion. So bear with me on this. That means total mortgages outstanding, 10.3 trillion. If you average it, divide it by the average house price, means there's 56 million accounts. So a private institution that is neither federal nor a reserve of capital, because they create the currency out of thin air and they give this to the banks. So this is quite concerning, very concerning news. So if we average it out, 184,000 per account, that's 15 million. That accounts for 27% of the entire mortgage market, and it's going up. This is going up all the time, and that's what really concerns me. Because as I said, yesterday's conspiracy theorist, like I was a conspiracy theorist last year on inflation. Today I'm accurate on it. No one says anymore, oh, it's a conspiracy. Well, what if there's something going on with why the Federal Reserve is buying all of these mortgages? That's one thing that concerns me. Why are they owning 27% of the mortgage market? Maybe there's something else going on here, but I don't want to get too deep into this. Hi, if you're enjoying this video so far, could you do me a quick favor? Just click the like button. Why not subscribe if you haven't already? And leave me a comment below. What do you think is going to happen to the housing market over the next year? I want to bring us on to this next FRED chart now then, and this is unemployment rate. Of course, they use the U3 unemployment rate, which is nowhere near the actual unemployment rate. You have to really go to U6 or even use Shadow Stats unemployment rate for a more accurate number on this. But we're just going to look at this U3. And of course, this got to 14.8% in April 2020, of course, when all the lockdowns and everything else began. And this has steadily come down. But you can see, even at 6.1%, this is almost double what it was in January 2020 before the whole COVID crisis began. So this is, and the funny thing is, the media keep celebrating. You see every week they're smiling, oh, great news today on all the job numbers. And no, it's not great news. The unemployment rate is still double, 100% more than it was in January of 2020. And one of my concerns is that this is going to get worse, especially if we go into this crisis that I see us going into at some point in the near future. I think the unemployment rate is going to get a lot worse. And that raises some of the other questions. And if you haven't seen my video on UBI, Universal Basic Income, I would definitely recommend watching that, because it raises a number of questions as to what will happen next with the US unemployment rate and labor force participation. I'm going to show you that in a moment, but this is the other thing to be aware of. So here we have Shadow Stats shadowstats.com. Highly recommend this site. And it shows the U3 rate, the U6 rate, which is more accurate, and that sits at about 11% there. But then it shows ShadowStats' actual alternative unemployment rate, which they put at 25.5%. Definitely some food for thought there on that. But now I want to show you the labor force participation rate, which I think is a much better metric than the unemployment rate. Now, I just want to show you this for context. During the last crisis, even though the unemployment rate dropped down, the labor force participation rate stayed pretty much the same. So we went from 66 to 65.7. So really, it didn't change at all, if you ask me. But then afterwards, it's been slowly dropping, this participation rate. And then we sort of plateaued here before going up in sort of 2019. But then look what happens once we get into the COVID crisis. And April 2020, the labor force participation rate dropped to just 60.2. And yes, it's come back up again, but still, it's still very, very low. And you might ask, why is this so low? Why is this participation rate so low? Personally, I think a lot of people have become dependent now on stimulus checks and the unemployment benefits, both from the state and from the federal government. Now, a lot of the states are blocking the federal unemployment now because they realize what a crisis this is creating. One of the reasons the federal government may not want to stop this unemployment or the stimulus checks is because this is helping with the velocity of money. It's helping to stave off deflation as well. It's helping to create inflation because all this new currency that's coming into the supply is having to be spent. People are going out and spending it. This is causing a shortage of certain items because people are going out and spending all of this additional money that they didn't used to have. But this, combined with inflation, is just helping to push up prices. So I personally don't think that is a good thing. But I just don't see the labor force participation rate picking up the way they think it's going to sort of 65%. They would have to get back up to this sort of level, which they haven't had that level since 2009. So you're talking 12 years ago since we saw this sort of level. I just don't see that 65% coming back, which raises a lot of questions as to the unemployment rate going forward. So let's move on to the migration patterns now then. And if you recall, this is how I sort of grew so big in the housing market forecasting and got a big YouTube channel, was that I talked about how I saw the migration data and the patterns moving over the next year. And I'm going to show you one of those forecasts that I made for the biggest movement in the housing market, which was Boise, Idaho. I'm going to show you exactly what happened there in a moment. So red is the origin and blue is the destination. So you can see we had this mass exodus from San Jose. As I said, the tech sector has changed dramatically. Tech workers are now working heavily from home. They are not being required to go back to an office anytime soon. So we're seeing this big exodus of tech workers from places like San Jose to Austin, Texas. We're seeing Seattle moving to places like Phoenix. There is just huge movement now. Los Angeles, so LA going to Las Vegas, going to Phoenix. And then on the East Coast, we've got New York going to Atlanta, Boston, Atlanta, and Florida, Miami, Florida. Huge movement from New Yorkers going down to Miami, Florida. And remember, the housing market is all about supply and demand. So what happened was, with this huge amount of movement from New York City, I said last year we'd see prices go down before they went back up again at a later date. And that's exactly what's happened. New York prices did go down dramatically last year before they've started to rise again. We've gone from a buyer's market last year into a seller's market again this year. Los Angeles, again, seeing a lot of movement. But again, I don't blame the people moving out of LA. I was just there a couple of months ago, and I honestly could not live in Los Angeles, especially in either downtown or the quite central areas. I simply just couldn't live there personally. It looks like a war zone, some of the streets when you drive around. And then here's the Bay Area that we talked about. So a lot of people leaving to go to San Jose, Austin, Texas, where I still believe we're going to see a lot more price rises in Texas, in Florida, very red states and didn't have the same restrictions and lockdowns as a lot of the blue states. So I do believe we're going to see some price rises increasing in those 2 states as we go forward. And then I want to show you my big one. So this was the big forecast I made last year, that Boise, Idaho would be one of the top performing housing markets over the next year or so. And look at this. This is crazy. So Seattle moving to Boise, Portland, Oregon moving to Boise, Sacramento, California, San Jose, Los Angeles. Wow, huge amount from Los Angeles going to Boise, San Diego, and then we've got Arizona. Where else have we got? We've got Washington, D.C., Denver, Colorado, Salt Lake City. So I think we can probably guess which way Boise is going to swing in the next election from all of this movement into Boise. Now let's get the Altos research online then, and just to show you Boise. Now if I'd have done this 2 days ago, this was the first time I'd ever seen 100%, so a score here of 100 as a seller's market. Today it's sat at 98. But I've never seen that before. A buyer's market is 30 or less, a seller's market is between 30 and 100. I've never seen a score of 100 before ever. Now let's just look at the inventory. Let's have a look at this inventory levels here. And when you have historically low inventory or very, very low inventory, what this does, it pushes the prices up. So where have we got inventory? We've got inventory here. Look at this, 80 to 90 versus the norm, which was 500 or more. So you can see there's just no inventory. And what does this do? It pushes prices up. So let's look at the median list price. And no coincidence at all that with the low amount of inventory, prices are just going up and up and up. In fact, if you were to buy a house a year ago, so let's jump on May. Okay, so if we were to look, or May, June time, you would have paid on a 90-day average $434,000. That same house today is $592,000. $150,000 increase in just 1 year. This, ladies and gents, is the craziness of the housing market right now. But just on the mass migration and the data, I don't agree with what a lot of the experts are saying, that we've now seen the end of this migration. It's over. We're only going to see a few people now moving. Most of it's done. No, I don't agree with that at all. What I think is going to happen is we're going to see more migration over the next 3 to 4 years. So why do I think this? Well, because a lot of people still want to move, but they've been uncertain. There's so much uncertainty over the last year. A lot of people are scared. They don't want to make any big moves. They're just battening down the hatches right now. So I think we're going to see a lot more movement. I think people have been affected financially over last year. Maybe they've lost their deposit. Maybe they had to use up their savings to get them through difficult times. Maybe their credit rating reduced. They've got to rebuild their credit rating. I think there's going to be a lot going on over the next 2 to 3 years for people to start moving again. And remember, some people will be swapping. Remember I forecast the people moving from the big cities to the suburbs and more rural. That was accurate. I think we're going to see more of that. I think we're going to see more people moving out of their condos in the big city and moving more rural now, or not necessarily more rural, but they want more house, more land, because you can swap a condo in some cities for a large house in other areas. So I think we're going to see more of that, especially if you can get very strong broadband. You can get more bedrooms, because remember, a house isn't just a home anymore. It's also an office. It's a school. It can be all sorts of other things. You want some recreation space. I think we're going to see another trend towards gardening again. People growing gardens, especially with all this uncertainty. And if you want a little tip from me, if you don't have a garden, maybe think about growing a garden over the next year or so. Start doing some canning. If you follow my channel, you understand why I'm saying that. But these are sort of trends that I think we're going to see a lot more of. So just a little bit more data here for you then. We've got the statistics right here of what people want to do. The majority of people, if you look at this, they prefer working at home. In fact, a survey was conducted recently where they said 70% of respondents said they would prefer to work at home than working in an office. And this wasn't just during COVID. This is into the future as well. This is the new preference. I mentioned as well some concerning things going on around pension funds and hedge funds. The Wall Street Journal just did a piece on this, and here's the title: If you sell a house these days, the buyer might be a pension fund. Why are they talking about this? This is a good article. It might be worth you looking at. But this is all to do with bidding wars and all sorts of other things going on. But let me read this out to you. So D.R. Horton, so this is a big house builder in the US, built 124 houses in Texas, and then rented them out and put the whole community on the block. A who's who of investors and home rental firms flocked to the December sale. The winning $32 million bid came from an online property investing platform, Fundrise LLC, which manages more than $1 billion on behalf of about 150,000 individuals. And ladies and gents, I think this is just the start of this movement. The hedge funds and pension funds buying up these houses. And let's put those to the side. You're also seeing all these large finance companies. And what they're doing is they're borrowing money at record low interest rates. So let's just use an example. Let's say that you get 2% on an interest rate and you're borrowing billions or hundreds of billions of dollars. And you go out then and you just start buying up houses, whole blocks of houses everywhere. And you get, let's say, a 5 or 6% return on your money. Think about that. Who wouldn't do that as a fund? If you can borrow at even 3%, but you can get 5 or 6%, you are going to make an absolute fortune on the margin. So this is what's happening. And that isn't even taking into account the gains. Remember, we've seen double-digit gains over the last year. It's forecast for double-digit gains again over the next year. I'm not sure about that forecast. I would have thought it would be a little bit lower than that. But the pension funds, remember, they're taking money. So your money, if you have money in a pension, they're taking these funds and they're using it to invest into the housing market. Again, I think that's quite risky. And you probably want to look at your fund where your pension's held, see what they're investing in for you. If they're investing in the real estate market, it's a good thing right now while these price rises are going on. But long term, this is not a good idea. The housing market will come down, ladies and gents. I haven't changed my opinion on this. It will come down. It just won't come down yet while we have all this huge amounts of liquidity going through the central bank and into the commercial banks, because the money has to go somewhere. The banks don't just want to keep all this liquidity on their balance sheet. No, their job is to lend money out, although it's not quite like that in reality. Maybe I'll make a video about how that works one day. But the bank doesn't really make loans, although that's what we think they do. But I'll get into that another day. But that's what they're doing. They lend this money out and get a return on it. So they don't want to hold all this liquidity that's on their balances right now. So they're getting it out. And what's the best thing to put it into? Houses, mortgages. So this is what we're seeing. This is the trend. And I think this is going to continue on for a little while longer while we have all this new liquidity until it sort of balances out in the marketplace. And it amuses me how many people keep saying, Neil, the government will step in sooner or later and they'll take care of this. They'll make it so that people can afford houses again. Why haven't they done that in the last 20, 30, 40 years then? The government don't care about that. Look, when your houses go up in value, what else goes up in value? Property taxes. It's not in the government's best interest to bring the prices of houses down to be affordable again. Because if they do that, they're going to collect less in property taxes. I just break everything down into common sense. I look at it rationally and see why the government would do certain things, why it doesn't do other things. Why is the Federal Reserve creating all this new liquidity? Well, it helps to push up asset prices, which is good for some organizations who might just be holding 27% of all the mortgages. Now, what are the other assets they own? What percentage was that? Let's just bring that up again. So that was 53% of all of the Fed's assets are mortgages. So what are the other 47%? Maybe it's something to do with the stock market. Who knows? But if I had to guess, I'd say the bulk of that could be in the stock market. You've just got to look at all this rationally you can't just trust everything that you hear in the media and from, the government and the Federal Reserve and everyone. You've got to look at it rationally and see what's really going on behind the scenes here. I also want to talk about the rent moratoriums in terms of how people can't evict tenants at the moment. Because a lot of experts are saying that this will end on the 30th of June 2021. Definitely this time, definitely. I would say nothing is certain anymore. So I wouldn't put all my eggs in one basket and assume that this will end on the 30th of June 2021. Some states have already taken action to extend this already without even waiting on the federal government to take any action. So also look at the wording. You've always got to look at the language that's used in the writing. So it says, the CDC's latest order extends the residential eviction ban until at least, here's the key word here, at least June 30th, 2021. So that would say to me that possibly it won't end on June 30th. It could be extended further. But even if it isn't extended, all these people talking about, okay, this is going to bring huge amounts of inventory onto the market and may cause a housing crash. It's possible, especially with all the mortgage forbearance ending and things like that. Some people are talking about Q4 of this year, so that's the winter period of this year. I'm not sure right now because, yes, we have this that may occur in Q4 with houses coming back on the market, and we've got rising mortgage interest rates. We probably have rising inventory levels. So this may help to soften this big incline we're seeing. But will it result in a crash, which I would define as 10% or more? Personally, I don't think so. I don't think it will happen that quickly because the housing market isn't like the stock market. The stock market can crash. It can crash quickly. The crypto market can crash 50% in a day or even more. But when it comes to the housing market, it can't just crash 20% or something like that in a day. It can't even crash 10% in a day. It takes a while. If you look at what happened in the 2008 crisis as well, yes, the housing market did crash, but it took a while. It didn't just crash overnight. It took many years before it really reached its bottom, before it started to come back up again. So I just want to give context to a lot of the language that both I use and other organizations use, because some people, they hear the word crash and they think, 50% crash overnight, in 1 month. But it statistically just isn't possible to happen like that. So yes, the mortgage forbearance and all the evictions could and probably will bring inventory back onto the marketplace. However, is this going to be in Q4? I don't think so. And the reason why is because, remember, I am a broker. I have a property management company. A lot of the properties that we manage, they've been where tenants just haven't paid or they've trashed the house and they had to be evicted or something like that. Some of these properties come on to our books from time to time. Now, I know how long it takes to evict tenants. It takes months. Sometimes it can be a 6-month process to get tenants out of a house who haven't been paying for 6 months sometimes. So this is a long-term process. So just because things might start, turning around towards Q3, Q4, so that's the maybe the summertime through to the end of the year time, it doesn't mean those houses are going to come on to the market at that time. It could be 6 months before they finally get onto the market. So this would take us through to next year, the summertime, maybe even next year or the springtime. But this is the peak. This is the highest times in the housing market, spring and summer. So it could even be, and again, I'm getting ahead of myself here because I don't really want to forecast, more than, now we're over a year ahead. We're a year and a half ahead at this point. This is when you could start to see a lot of changes in the housing market. This is when you could see, a large scale reduction. But again, there's still a lot of options for people with mortgages, with the forbearance. Some banks are going to allow people to add on all the missed payments to the end of the mortgage and things like that. So there still are a lot of options. So what I'm saying is I wouldn't put all my eggs in one basket on this theory that a lot of people have got right now on this crash in Q4 through to Q1 2022. But just on rising prices and being priced out of the market, I will say this. There is always a peak of affordability in the housing market. Always. Let me explain. Let's say a house is worth $200,000, and then over the space of, however many years this is taking, it goes to 250,000, or we have a crazy year this year and it's going up and up and up and it gets to 300,000. Those people will be priced out, especially because the mortgage rates can't really go much lower. So people will eventually be priced out because salaries are what they are, right? So if house prices are going up by 15%, but salaries are only going up by 5%, there's a difference there of 10%. And that's compounded as well because of the value of the house. Remember, we talked about the income ratio versus the price of the house. So it's compounded. So there is going to be a limit to how much people can afford and how much house prices will go up by. So either way, these, let's just say these housing organizations that you see all the time on the media who are saying prices are going to keep going up and that we're forecasting 15% this year, 17% this year, and all this sort of stuff. It's possible. However, and this is the caveat to it, there is a price limit. It will have to peak at some point, and I don't think we're too far off. I think it's going to be in the next year. We're going to hit this peak before the prices start to plateau and then start to decrease. Again, this is just mathematics. There is always a cap to everything. So I do think that this is all going to end very, very badly. I don't think this is going to end well for people that have gone into the housing market this year, who are getting into the market over the next year, and who may have got in maybe a year before that. I don't think it's going to end well for most people unless, of course, people have got a fixed rate, 20, 30 years, 3-4% sort of mortgage rate, and they can just ride it out. But for people who have tried to get a lower interest rate over the next few years, over the next 5 years or so, you may be surprised in 5 years when you come to refinance that rates might be a lot higher than they are today to counteract all of this inflation and everything else that's been going on. So as I summarize then, I want to leave you with a question to ponder. Did house prices really go up by double digits this year? Or did inflation go up by double digits this year, combined with the purchasing power of your dollars going down dramatically? Have a think about that. And while you're doing it, please click the like button, subscribe if you haven't already, and I will see you on the next video. Take care. God bless.